Now, investors in Nigeria's fixed income and money market space will be looking forward to a primary market auction on Wednesday. The April 9th auction saw 800 billion naira offered with a subscription of over 1 trillion naira. The market will be looking to see if stop rates move up on Wednesday, as they did with the 91 and 182-day tenors, rising by 50 and 100 basis points respectively. What can investors look forward to? Ajibola Tobi-Osho, with financial market specialist, joins me now to discuss this further. Ajibola, good morning. Always a great pleasure to have you on the show.
Good morning.
Right. Well, let's get right into it. So we have the primary treasury bill auction this Wednesday. If we look at April 9th, we saw a rate movement between the 91 and 182 tenors, but not the 364-day. What do you expect in terms of Wednesday's movement?
Well, for the last two auctions, we noticed that the DMO have been managing auction. I mean, not even for the last quarter, they've been managing the interest rate. And we can expect that, given that our debt services have ballooned, that's Nigerian debt service has ballooned. So they have been very intentional at the rate at which they raise securities at the moment. So I would expect that it tapers around where, or even drops lower, because these bills are trading way lower in the secondary market. And coupled with the fact that, like I said, they are really managing market expectation in terms of interest rate. They are hoping that, given that they've done rebasing on the inflation level, and inflation levels are looking around 24%, then why shouldn't they start continue raise treasury securities at high levels? So we'll see a lot of management at the auction, even for the bond auction at the interim. So I don't expect them to raise rates for this auction. I expect that participants that are even going to bid for this auction will be very cautious at the rates at which they bid. So we'd expect a bit of tapering down. If it's either it closes at the same level or it tapers down, but I don't see any uptick.
You don't see it going up?
No,
okay, well, let's talk about factors that move the rates for the different tenors, especially when it comes to treasury bills at the primary level. What factors are responsible for
most times it's moved by the demand that the demand they receive from, I mean, the bid they get from the public, right? The bid they get at each level, at each maturity. For quite some times, market mostly shuns the 91 and 182 days. The preference is always more at the long end of the curve, right? So that's why you see a lot of uptick, a lot of aggressiveness on the short and the medium, and then they kind of just relax themselves on the long end, because you get to see a lot of sizes. If you go through the script, you can see that the subscription for the 182 days and the 91 days was quite low compared to the 1 year. The 1 year had over 900 billion on it. So because of the size you get to see on the 1 year, they're able to raise as much, they're able to cast their nets as much as they can, but not so much for the 91 and the 182 days. So most times it's actually the subscription they receive that drives the rate.
Okay, that makes a lot of sense.
But another thing they try to do and ensure is that they still want to maintain an upward sloping curve, meaning that the 91 days rate has to be lower than the 182 days, and the 182 days rate has to be lower than the 364 days. But aside that, the volume is what drives.
So that would be the only exception.
Exactly.
Right.
So you might never see, at the interim, you should never see the 182 days higher than the 364 days, for instance, or the 91 days higher than the 182 days. You get to see an upward sloping curve. That is what they've maintained for a long time now.
Right. Okay. Well, I mean, as we all know, Nigeria's headline inflation rate for March came in at 24.23%, with the true yield on the 364-day bill leaning at 24.42%. For the benefit of our viewers who don't really understand what the true yield is, let's talk about it definitionally.
Okay, so when we talk about true yield is it's what you're earning actually. So let me put figures to it. Say, for instance, you have ₦1 million and then you decide to buy treasury bills. And say for that auction, you had the auction closed at 20%. That means what you're going to be earning is 200,000 naira. At the day when you buy the auction, what you're technically going to be debited for is 800. You'll be debited 1 million and then you'll be credited 200,000. Normally for fixed deposit and other kind of instruments, you get your interest at maturity. But in the case of treasury bills, you get your interest the day you are investing. What that means is you have the money at hand to spend, or you have money at hand to do whatever it is. And then technically, if we look at it, what you actually invest is 800,000, not the 1 million that you bought. Because at maturity, you will get 1 million. So if you do a quick math, 200,000 divided by 800 is actually what you earned on that investment, because what you actually invested was 800 to get 1 million at maturity. I don't know if that makes sense.
So basically, that figure is subject to what?
Exactly. So you're getting your interest. You're getting your interest today. technically, and what you debited for is the discounted amount, not the face value.
Hence being the true yield.
Exactly.
All right. Well, I think that's very definitional. Well, let's move to bonds now. The last retail savings bond for April was 16.046% for the 2-year and the 17.05, I don't want to misquote any numbers here, for the 3-year. As they both be below the headline inflation, would you say that they're still worth investing in?
I think for retail bond, it's actually, you see interest from strategic investors. They are the ones that really look at that. For people that want to manage their cash flows, I speak to some investors that usually trade the retail bond, and they tell you what they are interested in is just to get monthly coupons. So they want to arrange their cash flow such that they're able to get monthly coupon every month to, fix some certain needs. And remember, the retail bond actually is very small size. With 10,000 Naira, you can actually invest in it. So I think because of the size, also the fact that anybody can get to invest in it, it makes it, for strategic investors who are looking to manage their portfolio and somewhat, and for some investors that don't want to be exposed to duration, say 5-10 years, but they want something a bit longer than the 1-year treasury bills. So those are the people that actually focus on the retail bond. And yes, they do, have it in their portfolio to smoothen out the portfolio. They just want to have a variety of instruments to, smoothen out their portfolio to some point. So, and then when we look at it from Nigerian long-term inflation, our long-term inflation rate should be around 14% to 15% in terms of long-term. Not now. So looking at that from all perspective, you just see people trying to manage their portfolio with different kind of instrument. Like I said, it's just a way of smoothing out and a way of exposing yourself to monthly cash flow such that you're able to manage your needs. So
is this a function of diversification and risk appetite as well? Yes. Or that has less to do with it?
Yes, it is a function of diversification and risk appetite. And also, like I said, managing your cash flow. So say, for instance, if you're able to invest in the January, February, March, April retail bond, then that means for every of those months you'll be receiving coupon.
All right, so it widens your scope of influence.
Exactly.
Which, very smart investor
one
would
say
it
looks like your salary, you're earning salary from your coupon.
Absolutely.
That's how some investors just get to manage their books. It's just for quick, just for quick spendings. For spendings are not very rigorous. You just want money to be taken care of. So I think that's what you see there.
Well, moving to sovereign bonds, how would you gauge the investor appetite? Let's looking at the last auction in March.
Well, the truth is that for some investors, whether they like it or not, they still have to invest in the local market. Say, for instance, the PFAs and some asset management. So whether or not they like it, they still have to buy, and they still have to come into the market to buy. And we have quite a number of maturities in terms of, and also coupon that came in for February and for March, and also we'll still get more for April. So in this next auction that we get an auction, I'm sure maybe next week for the month of April, we'll still continue to see flows. There's no choice. And like I said, the DMO has been very intentional with the way they are managing rate across all instruments, say the retail bond, the treasury bills, and the bond itself, so sovereign bond itself. So they've been very, very intentional at managing rates. It's clear that they are very concerned about our debt service, and they want to keep it as low as possible, despite the fact that they have a very, very large budget to fill. So we see a lot of cautiousness in at which they raise rates. They are telling us to our face that if you're not going to buy at this level, you can take away your money. So I think because of that, that's a direction for market, and I expect that investors that want to go into that auction would take a cue from that and quote bid around where the DMO are comfortable at, which I think is around 20%.
Okay, so should a balanced and healthy portfolio include these three: treasury bills, sovereign, and retail bonds?
Yes, like I said, it's all about your cash flows. It's all about what you need. You have large corporates have or PFAs, they have monthly payments that they have to make for they have to disburse. So you just have to manage your portfolio as much as you can. And yes, being exposed to all this kind of instrument, yes, it is. At times you are, look at the treasury bills too. In order to get access to about 24.5% yield, you want to buy that. And then also you want to look at long term where, say for instance, treasury bills continue to drop in terms of yield, so that you're able to lock in high rate at the long end of the curve. So yes, it's okay for you to have, across all board, not only Naira, you can also include a bit of of dollar into your portfolio. It's just to have it across all board.
Yeah, fair enough.
Yes,
well, I mean, let's look at risks now. What are some of the risks associated with investing in fixed income and money market instruments in Nigeria?
So, for the fixed income market, technically, to some extent, that's why it is called risk-free rates. So, and that's because to some extent it is backed by the federal government, and market always expect that, God forbid, we have an issue where we are unable to pay up. The worst that would happen is that maybe the coupon level will be restructured, but nothing would happen to your money. So, like I said, in terms of economics and in terms of financial, we call it risk-free rate, meaning you don't have any risk attached to it. So maybe because of what happens in Ghana, you can attach a bit of riskiness in it. But I can tell you that for the fixed income part, yeah, it's near to no risk. But for money market, I think it's tied to the company that is giving out this money market. Do you understand? The risk is tied to the rating of the company. So say, for instance, an Islamic asset rating is maybe higher than an ARM rating, maybe higher than another smaller asset management company. So the money market fund that they push out would carry out their rating. So that's how that started. So the risk for money market is tied to the company that is issuing that money market fund, while that of fixed income is tied to federal government, which we can assume to be risk-free.
All right, that's very well explained. Yeah. But what's your rate trajectory outlook for these instruments for the rest of the year?
So the rest of the year is a bit far-fetched because we've had a lot of uncertainty in terms of the international world and our local market. I mean, the fact that we can see all that is happening in the Trump space, the tariff war between America and the rest of the world, it would definitely dovetail into emerging market and the developing countries, and then it would drive our interest rate. So I don't think we can look at it in the long-term way. I think we have to start picking it step by step. So for the quarter, what I expect is that the DM will try as much as possible to keep it low and keep it at this level that it is. I don't see them aggressively wanting to raise rate. However, if there's any strong toggle at the off end of the world, and then we see the toggle trickle into our market, then there will be nothing they can do, because at the end of the day, the international space still control a lot of things. If there's sell-offs, if there's pressure on FX, for instance, if there's a reason for FPIs to want to leave and go to safe haven currency, for instance, because we've seen a lot of commodities interest for most of all this currency. A lot of currency, they're selling out in all emerging markets to go to commodities like gold and the rest. If you continue to see that, yeah, there may be a bit of pressure, and then you see upward tick in interest rate. However, the level at which the DMO have been intentional in keeping rates at the minimum at a level, I think they will continue to do that for the quarter. Like I said, it's far-fetched for us to talk about a year, to go all the way to a year, but because of what is happening all around the world. But I expect that they will still try to keep it as much as they can on this level.
Right. So external influences also play a role?
It plays a whole lot of level in terms of even our FX rate, because by the time you see the large investors leaving the Nigerian market, selling off our instruments to take out their dollars to go to safe haven, that would affect us also. That would make dollar rates go up, and as a result, the CBN may have to react by raising interest rate. By raising interest rate, you see that to dovetail into our fixed income market, and also that's a bit of what you see from time to time. But I mean, like I said, the DMO's part will continue to play their part by managing the interest rate and ensuring that they try to raise rates at reasonable level as possible.
All right, Ajibala, always insightful. Many thanks for joining us on the Global Business Report. We'll surely be seeing you again.
Thank you.
Enjoy the rest of the day.